Welcome to the daily update, where I'll go over the action in the market for Thursday, March 13th, and we'll see how things look for Friday, March 14th. Had another down day, seeing even some longer term deterioration when we look at the charts. We're overextended to the downside in the short and intermediate term. We're even getting a little bit oversold in the long term, but things are quite negative now as there's a lot of uncertainty about what's going to happen with the tariffs, with Doge, with the economy. And we had CPI and PPI come out this week. They were actually market friendly, but the market just can't seem to go up. All right, let's go back and talk about what happened right at the open. We had a flat open, but then right after that, prices declined to S1 at 55.50. We rebounded, but we hit resistance right at the daily pivot at 55.96. And I post these pivot points in S1, S2, R1, R2 levels. I post them every day on the YouTube community tab. So they're right out there. You can check them out, and they're very helpful because these are often very critical points. Then, once we hit the resistance at the daily pivot, we declined back below S1 again, and we got almost down to S2 at 5,500. As the day went on, we rebounded, but then we hit resistance at S1, and we declined to close almost at the intraday low. We were down 1.39% on above average volume. We are still negative in the short intermediate term. We're mixed now in the long term because we're below the 200-day moving average, but the long-term trend is still positive. And inflation seems to be a little bit more friendly. Now you go under the surface, and there's some things that came out in these reports that are causing the market some concern. But right now, it's like good news is bad news, and bad news is bad news. The market's just seeming to go down. Now, have we overdone it? We're still looking really extreme as far as sentiment. We have a pretty long list of oversold indicators in the short and intermediate term. Could that produce some kind of a bounce? Of course. But we thought we might have seen a bounce by now. What we'll be watching for is if we do see a bounce, are we going to see selling into any strength as we're getting set to go lower? That's just part of the scenario that we're working with right now. Some comments now. On a closing basis, the S&P is now in correction territory. On a closing basis, it's down more than 10% from the all-time high set, seems like ages ago now, back in February. The NASDAQ was already in correction territory, so now we have two indexes that are in that correction territory camp, and that's just when we have declined 10% from the all-time high. Then there are fears that the U.S. trade policy may negatively impact inflation in the future. That still continues. But this has been the overriding theme that the market's using right now. And then President Trump did announce a potential 200% tariff on European beverage imports, including wines and spirits. That could really hurt because if you're into wine, French wine and Italian wine, they're all very popular. And this was in response to the EU placing tariffs on American whiskey, intensifying fears of a prolonged trade war. And it seems to be that I've been pointing out, and based on what I've been following, the tariffs were an idea to use in order to negotiate. Well, now it's turning into a trade war, and it's like we're trying to out tariff each other. And the idea is that President Trump says, I'd like it if all these tariffs went away, but you're already putting tariffs on us. We want to put tariffs on you. And now you see that as unfair, where it was unfair towards America before. And then it's like they're trying to one up each other here. Mega caps and growth underperformed for the last couple of days, especially in Wednesday's session. Mega caps and growth, that's what helped the market go up. Didn't help in Thursday's session. And we're being really challenged with the long-term support for the S&P 500. That's a weekly chart of the S&P with a pivot point that lasts for a whole quarter. We're below that right now. Now it's a weekly chart. So if we have a solid day on Friday, we could actually get back above that because the chart won't actually be completed until Friday's close. We're still above 20 with the VIX. We're at 24.66. Long list here in the short term. We have our short term ADX. That's what I use to measure the condition of the trend, whether it's a strong trend or a weak trend, and then what is the direction of that trend. We're still looking extreme with the 20 period exponential moving average. That's on the S&P itself. And then we have a number of rate of change charts going back 5 periods, 10 periods, and 20 periods. These are all short term. They're looking extreme negative. And then we have our list of those usual charts that whether we're moving to the upside or the downside, they're always on the list. We have the Stochc RSI, Williams percent R, CCI 14 and 20, the stochastics. Those are the usual ones. And then we have standard deviation. We're still down in that -3 channel. The slope oscillator and all of our oscillators are starting to look extreme. And I point that out when we get to the chart. We're still far away from the 20 period moving average. That's the boom 20. The short-term RSI is extreme negative, and we're going down even more with those stocks that are above their 20 period moving average in the S&P. Then on an intermediate term time frame, the rate of change going back 50 periods is extreme negative. We're starting to see the McClellan oscillator for the S&P go extreme now. The PMO studies that we look at, and then the bullish percent index for the NASDAQ 100. So we're seeing some charts that we usually don't see on this list. And when we do, it's more negative because this list just keeps getting longer. We're also quite far away from the 50 period moving average. That's the boom 50 to the downside there. The TTM squeeze, the Sean trend meter, and then the intermediate term RSI based on 14 periods. And even in the long term, we're dropping down and looking extreme with our 150 period moving average on the S&P. We still have a non-confirmed Hindenburg-Ullman. We're waiting for another signal. That needs to be generated by March 31st. No change to the overall scenario as it concerns the Fed and interest rates. The dollar was up and interest rates were down. We're at 4.27% with the 10-year yield, where we had been at 4.32% with the 10-year yield after Wednesday. We're just camped below 25, which is very strange. Usually we come down to around the 25 level. That marks some kind of capitulation, and then we bounce up out of that. We've been down below 25 for quite a while and just sitting here. If we have an up day, we go up a little bit, but we're still below 25. We have another down day, we go down even more below 25. It's coming in at 15 right now, where after Wednesday it had been at 20. And the 10 to the 3 month yield curve is back to being inverted again. That's kind of switching day by day right now. As far as our trend, we are negative. The ADX is getting stronger, which means the trend is getting stronger, and it's negative because the red line is above the green line, and we're above 20. We're above the moving average. And then with the down day, the bias is negative, and the momentum, which is the last 2, 3, 4, 5, 6 days taken together, I kind of jumble them up. That's also negative now. Economic reports, PPI came out unchanged. They expected it to be up 0.3%. Last time it was up 0.6%. The core PPI, this is the inflation part, it was actually down 0.1%. They expected it to be up 0.3%, and it was up 0.5% last time. And then jobless claims are coming out, and they're fewer than expected, which is showing that the employment situation area is really holding up. They came in at 220,000. They thought it would come in at 228,000. Last time it was at 222,000. And then the continuing claims also coming down now. We had a week ago, this was still going up. Now it's starting to come down at 1.87 million. Last time it was at 1.897 million. So here are some charts. This is final demand year over year. The total reading for PPI has this going down, but we're still above that 2% level. And then the core, that's the inflation component. It's also coming down, but still above the 2% level. And then breaking it out based on goods, that's the blue line, that's going down, and services are also going down. Intermediate goods, processed and unprocessed, where we have processed are flat, unprocessed are actually going up. And then here's a chart just to go back over the last year and the last month. We're declining a bit on a year over year basis here, and the market should like that. We're also declining on a month over month basis. And then we look at the core PPI, where we're pretty much flat there on a year over year basis. And we actually ticked up when we look at the month over month change. Then every week we get the weekly jobless claims. They're actually going down, but the moving average is still going up. And we also get continuing claims, which is coming down, but the moving average is still going up as well. And then putting them together with the unemployment rate that we had last Friday, we're coming down a bit here with the continuing claims and the initial claims. And we're at 4.1% with the unemployment rate. Then looking at some charts here, this is the deviation of earnings above or below the long-term growth trend. We're way above right now. And you can see other times when we got up into this red area, this is when things tended to happen that were more negative. We don't know if it's going to lead to something like that now or not. And then stocks have bottomed on March 12th, the last 20 years. Well, we had an up day on Wednesday, so they're like, okay, maybe we'll put this chart up here. You are here. And then a lot of times, right around the beginning of March, at least over the last 20 years, this has marked some kind of a low, and then we've been able to come up out of it. But okay, it hasn't happened yet. And then the mega cap tech stocks trade at their lowest valuation premium to the rest of the market in quite a while. It's really coming down, which earnings are still looking good for these companies, even though projections are coming down. But since prices are coming down, the forward PE is coming down as well. And then S&P 500 corrections are usually good buying opportunities. Well, yeah, you can say that pretty much about anything. But when you use this buy the dip type of idea, which I do not believe in, because somebody thinks it's a dip and maybe price goes in your direction for a while, but then we turn and go even lower. I mean, tell that to all the people this past week who've been trying to do that, thinking, oh, I'm getting in. This is a buying opportunity. And then we end up going even lower than that. And now suddenly you're seeing a loss with that. But it really comes down to timing. And the further out you go, especially when we don't go into a recession. And we still don't know if that's going to happen. There are some things to suggest we will, and there are some things that will suggest that do suggest that we won't. We don't know that at this point. And the S&P 500 has experienced a median annual drawdown of 10% during the last 40 years. And it's very common. We're at near that 10% level now. And even during good years, it's very common and normal to have a drawdown of about 10%. What we're trying to figure out now is it going to turn into a 15% drawdown, a 20% drawdown? That's when we're actually switching over and we're in a technical bear market if we end up dropping 20%. The Magnificent Seven have lagged during the recent drawdown. Yeah, I mean they led the market higher. And so when we're under some pressure with the market, they lead it lower as well. And then this is the break even rate. And this is interesting because this shows that we're actually coming down. And this means that inflation seems to be under control. So that's what the market is anticipating. And over the weekend, I'll do a number of different charts where we look at this, and we're in a lot of areas we're seeing some improvement where everybody might be talking about the fear of inflation, but the charts are showing that maybe the market's not as worried about inflation. But come back and look at the weekend videos when I'll be going over that. Then stocks appear to be pricing a GDP growth outlook slightly below the Goldman Sachs forecast. Okay. And then we model a slight rebound in the S&P 500 PE ratio during the next several months. Okay, you can do that if you want to. It, ultimately comes down to price. And right now, everything is quite negative, but we've been extreme negative. And it's when are we going to hit bottom with this and get some kind of a bounce? And that's what I've been really watching now is if we do get a bounce up and we get back up to the 200-day moving average and that acts as overhead resistance, that's going to be very telling. But if we can go back and recapture that 200-day moving average, then that means that maybe we'll be able to recover from this. But there's a lot of variables to that, and we're not even close to doing that at this point. Then this is kind of interesting looking at the sellers here. And then what happens? This is from sentimenttrader.com. We're seeing a very low reading here. And the takeaway from this is that when we get very low readings with this is when individual investors are very pessimistic about things. Well, we've seen 3 weeks now, and I'll have the chart here to show you in just a moment, where the individual investors have come down and been extreme negative for a period of time. What does that mean? Well, a week, 2 weeks, a month, 2 months, and the returns are not all that good, but sometimes they're fairly good, where it has the average loss and then the average gain. And usually, when you go out a little bit further, that's when you see better gains going forward. That's why we tend to use this as a contrarian indicator. But as I said, this is the third week now that they've been extreme negative. And then equity capital is moving from west to east. This is another thing that I pointed out over the weekend, last weekend, that Europe has been really outperforming the US so far in 2025. And so now folks are trying to chase that. And the only bad part about that is that when you're chasing something that's already been successful, a lot of times folks arrive late when that happens. And then S&P 500 stock price index against the individual investors surveyed. This suggests that there could be more room to go down. Now we have the survey about how people feel, but this is the percent of stock less cash portfolio position. This suggests that we might still have more room to go down from here. They may not feel good about things, but they're having a tendency to ride it out, thinking that we're going to bounce back. Well, if we keep going down, eventually they're going to sell, and that's going to push this red line down. And this kind of goes contrary to what you might think. This just shows how the when we look at since the financial crisis and we look at earnings, this shows how the rest of the world has underperformed the US. But we can see here it's really starting to come up as the US is starting to come down a little bit here. And looking at our intraday chart where we had pretty much a flat open, came down to S1, bounced back up, hit resistance at the daily pivot. Then we started to drift down. We dropped below S1, didn't quite get down to S2, but we came right around the 55 or the yeah 5500 area, which is a nice round number. Tried to bounce up off of that, hit resistance again at S1, and then closed down from that near the low for the day. And the futures are actually up pretty strong as I record this, but as I always say too, it's many hours before the market opens. And when I'm recording this, Europe hasn't even opened yet. And we're still seeing something okay here where the blue line and the red line are about equal with each other. Now they're both going down, which is negative, but we had been seeing where the red line was quite a bit above the blue line. That means that value was outperforming growth. Well, over the last few sessions, we're seeing growth show a bit of an improvement right now, even though it did decline in Thursday's session. And this is where we've been picking up potentially some improvement here. We're starting to bounce up with our growth to value ratio for the S&P. Now, I got hit on Thursday, and we could just resume the downward move here. But if we do start to go up, that's going to be more positive because that means growth is outperforming value on an intraday basis. And growth just got hammered on an end of day basis here. It was down almost 2%, where value was down, but down 0.88%. Mid caps down almost 2%. It was also down more with the small caps. So not really helping our growth to value ratios here with the small caps or the mid caps or even with the S&P. and still dropping further below the rainbow here when we look at growth versus value using these ETFs, and still going down with our discretionary to staples. Now, staples have really pulled back, but we're seeing a lot of equal weakness right now in the discretionary sector. It's not all Tesla right now. This treats all stocks, at least this particular ETF does, it treats all stocks the same. So things are not looking really positive right now. In fact, we're still showing a strengthening trend in the intermediate term, and it's negative because the red line is above the green line. The short term, we're above 40. That's when we say, okay, maybe we're getting a little toppy here, but there's no magic about us having to stop at the 40 level. We can go way above that, and we're above that now, but it's clearly a negative trend in the short term. And we dropped off a little bit with volume in Thursday's session. And we're coming down just a little bit here with the Ulcer Index. This is kind of like the VIX for mutual funds. And ticking back up, but still above 20 with the VIX on a closing basis. Also, when we look at the bar chart, the VIX of the VIX also did decline a little bit, which maybe folks are getting a little bit more under control now, even though it was a down day. We're actually seeing some of the fear gauges decline, but the momentum for the VIX is still up overall. But you can see we've been kind of coming down over the last couple of sessions. And we tick down with this fear gauge, but we're continuing to go up with this other fear gauge. So a bit of a non-confirmation there as far as rising fear. One was actually going down. This is the individual investor survey that comes out once a week. For 3 weeks now, we've been below this 30 level, and that means that individual investors are extreme negative. But a lot of times we'll just come down here and then we'll get one reading that's extreme and then bounce up out of that. Well, we've come down here just like our other sentiment indicators that we look at. It's like we're camping now in extreme negative territory. And we're still coming down here for the most part when we look at the risk on to risk off ratio. That means there's fear coming into the market. And we're also watching this. This is the spread between risky and not as risky bonds. This continues to go down, and that's a concern. This is an inverted chart of what I just showed. And when this is going down, that means fear is increasing. And we saw a real spike up here with the equity put call ratio on the daily chart. We're going up with the 5-day chart and the 10-day chart, and that's negative. That means maybe that we're now into this 10% area. We're seeing a real increase in hedging. This goes up when more puts, which increase in value as the market goes down, are being purchased than calls, which increase in value as the market goes up. But here we're kind of just about at the midpoint. When we look at volatility risk premium, this tries to measure fear also like the VIX going out for the next 30 days. This is actually declining and not really showing a real increase in fear. And we're seeing, excuse me, we're seeing a little bit more weakness here with the advanced decline line based on price and volume, but we're still above these long-term moving averages. And more weakness here with our advancers decliners over the last 10 periods. And seeing real weakness here. Virtually no new highs and an expansion of the new lows. So we're going down with the 5-day and the 10-day moving average of the new highs minus the new lows. We're below zero and declining with the short and intermediate term advanced decline ratio. And we're just barely, it's probably hard to see, but we're just really starting to go underneath the red line. This was the big holdout. This had been holding up. And so if we see more weakness in Friday's session and going into next week, if we stay under this red line, that means the smart money is not really coming in and doing any buying. They might actually be doing some selling. We're still declining here with our other smart money indicator. We're actually dropping below the midpoint and turning red, and the red line is coming down. So smart money indicator number 2 is negative, and we're declining with smart money indicator number 3. We're negative here with the red line above the green line with the vortex. And I didn't show these in yesterday's video, but we're seeing a little bit more action here with our advanced decline lines. This is for the S&P based on price, or this is now showing a little bit more conviction, and we're declining also based on volume. declining with the cumulative advanced decline line for the NYSE, dropping further below the moving average with the regular NYSE advanced decline line, and also dropping here when we just look at common stock based on price and volume, and coming right down to the 200-day moving average with the other NYSE advanced decline line. This could act as some kind of support here. We'll have to see if how that plays out. And we're dropping below the moving average here. We were holding out as the S&P advanced decline line was holding up. Now it's dropping down. All the major indexes that we follow are negative with the advanced decline line studies. Still getting extreme negative with those stocks above their 20-period moving average inside the S&P. We're down to 19. Only 19% of 503 stocks are now above their short-term moving average. And we're declining with the 50-period moving average study, the 100-period moving average study, and the 200-period moving average study. Quite a decline that we've seen here. And we're still above this purple line, which goes back to the low set in October 2023. We broke below this low that was set a year ago, April 2024. We're just going to see if we continue to fall. Will this purple line provide some support? And we're down over 10% now. Now, I measure this based on an intraday basis. The 10% that you might be hearing about in the financial media, that's on a closing basis. So this just shows it as a higher percentage. And so, yeah, we are in correction territory now and falling further below the 200-day moving average. But we actually saw volume dropping off a little bit here. To have PPI come out, which is a major report, and to see volume dropping on a down day. Okay, don't want to read too much into that because we've been above average as we've been going down. But if we're still going down and we're seeing a decrease in volume, does that mean that maybe the selling is exhausted itself? We don't know that for sure. Just something to think about. We're extreme negative with the 20-period moving average on the S&P, declining with the 50 and the 200. And we're way far away from the 20 and 50-period moving averages. We're below zero and declining with our distance away from the 200-day moving average. And then our usual charts here. The Stochk RSI is extreme negative. Williams percent R, CCI 14, CCI 20. The stochastics are all extreme negative. The force index is negative. The condition of the short-term trend continues to be negative. And when we look at the rate of change going back 5 periods, it ticked up a little bit, but we're still below this red line. So we're getting an extreme negative reading there. And then we go a little further out, the rate of change 10 periods, also below this pink line, even though it's bouncing back up a little bit. But when we go out to a 20-day rate of change, we're still declining below this pink line. And we're in the -3 channel with our standard deviations chart. That's considered extreme. And we're still going down, even though we bounced up a little bit here with the balance of power. That's negative. And dark purple here, or deep purple if you prefer, with our go, no-go system. Lowest low value chart still shows weakness there. TTM squeeze, drop below this black line. That's still extreme negative. And this is longer term. And this is more of a deeper reading than what we've seen shown on this chart. And this goes back, I think, 2 years. And then I thought I showed this, the rate of change going back 50 periods. Below this green line, but not quite down to the pink line yet. Standard deviation just shows that we've been moving down pretty fast. Ticked up a little bit, but we're still negative, quite negative with the ease of movement. The Arun indicator is still negative since we're below zero with the oscillator. And we're starting to get extreme now with the McClellan oscillator for the S&P, dropping below this -60 level. Now, we could go further than this, but this is usually a line saying that we're getting extreme negative. So when the McClellan oscillator is below zero, that means the summation index based on price is going down, and we're also declining based on volume. And then we look at the NYSE McClellan oscillator, not extreme yet, but it has been showing weakness. So we're going down with the summation index for the NYSE based on price and volume. The Swindlen Trading Oscillator declining based on price, a little bit less here based on volume. And we're extreme now with the PMOs inside the S&P that are rising, that's giving us an extreme negative reading. We're still declining with the buy signals and with the PMOs that are above zero. Momentum, getting down to an extreme reading here with the PMO, the price momentum oscillator. Then we break it out based on price and volume, and those are both declining. And we're negative with the Elder's Impulse System for the S&P. We're negative with the Parabolic SAR. We're negative with the intermediate term trend. We're negative because we're below all the moving averages now, and these other moving averages are starting to roll over. It's kind of like a waterfall at this point. And the slope oscillator getting extreme negative here, getting extreme negative with the MACD. And so looking at all of these together, you can see the slope oscillator is extreme, as is the TSI. Those are our two short-term indicators, getting extreme with the MACD, the PMO, the PPO. We're still declining, but you could make a case that we're getting extreme with our longer-term oscillators, the TRIX and KST. The Copic curve continues to be negative, and just to give it a little bit more context, this is a longer term look at the Copic curve, and we're seeing quite a low reading right now. The last time we saw this was back in 2022 when we were in a bear market, cyclical bear market at that point. So this is getting extreme. It could still go down more than where it's at, but just to give it some perspective with what ranges we've been seeing lately. Sean trend meter is still extreme negative, and we're below 50 with the ultimate oscillator. The money flow bounced up, but it's still below 50. That's also negative. We're below the moving average, and now the moving average is starting to roll over with unbalanced volume. We're extreme with the intermediate term RSI and the short term RSI, extreme negative. And the bullish percent index continues to drop as well. That's negative. We're dropping with the NYSE bullish percent index, and we're starting to get extreme negative now with the NASDAQ 100 bullish percent index. And we're waiting to see if the mass index is going to trigger a signal. It hasn't. There are three criteria. It's met two of those criteria. We need this line to come back down below the red dash line for the third criteria to be met. And we still have not received a buy signal with the Pring bottom fisher. And we're falling below the 50% retracement level. Are we going to go all the way down to the 38.2% retracement level? We've just been slicing through these longer term Fibonacci retracement levels. This is the big one that I've been focusing on. This is a weekly chart of the S&P with a quarterly pivot, and we're below this P right now. Now, in Friday's session, if we have an update, we can get back above that. But for right now, we're losing this long-term support. We're declining with the Heikin Ashi, declining with the Renko chart. The Kigi chart is negative, and the three-line break chart is negative. Long term, we're starting to cross below the red line here. This is the special K, and I usually show this chart in the deep dive video because we don't get very many signals. The last positive signal was back in late 2023. Now we're starting to cross below the red line again. That could be longer term negative. And we're starting to get extreme negative with our 150 period moving average, still going down, but not extreme with the 200. And it's not really seeing much of a change here. We're still negative in the short and intermediate term with all the different stock indexes that we follow. No changes here either. Bonds are positive in the short and intermediate term. Commodities are still negative in the short term, and the dollar is still negative in the short and intermediate term. All of the sectors except for utilities ended up being down, with this discretionary and communication. Those are two big growth areas. And tech, the other big growth area, those ended up leading things down. And nothing but red here. It's like Valentine's Day. So lots of crosses for the NASDAQ as it went below 17.6, 17.5, 17.4, eventually 17.3. We're seeing a BPI with the materials cross below 20. That's a pretty significant, that's oversold at that point. We're crossing below 50 with healthcare, which is defensive, but it's starting to see some pressure now. The Dow went below 41,000. Energy had a BPI cross below 20. That could be extreme negative. And then we had discretionary. This is another growth area. It's also having a BPI cross below 20. So when we're seeing low readings like this, below 20, that could mean we're getting extreme negative, and that maybe the selling, might start to calm down. But we've been seeing signs of that now for about a week, week and a half, and any buying just comes met with more selling. And we're going down a little bit faster now with the red line. That's the equal weight version of the S&P. It's actually underperforming where it had been holding up a little bit better when we compare it to the weighted version of the S&P 500. And we're further below the 200-day moving average with the Dow. We're negative with the Elder's Impulse system for the diamonds. We're starting to drop below this S2 pivot point here with the NASDAQ. And we're still, well, we're dropping below it here with the S2 level with the NASDAQ 100. We're losing pretty significant support here. We're still neutral though with the Qs when looking at the Elder's Impulse system, but the momentum for the NASDAQ 100 is negative. The small caps just keep going down. It's like they're just slicing through all kinds of support levels. And another day or so, and unless we get all the way back up to these lines, we're probably going to see a death cross here, which would turn the trend for the small caps, the S&P 600 anyway, negative. And we're getting pretty close here with the Russell 2000 small caps. We could be getting ready to see a death cross here as this index just continues to look really weak. We're still neutral though with the small caps when looking at the Elder's Impulse system. Mid caps also showing a lot of weakness, rolling over with the 50 period moving average and not quite down to the 200 yet. And we've gone from neutral to negative with the mid caps with the Elder's Impulse system, falling further below the 200-day moving average with the Wilshire 5000 and the total US stock ETF. And financial sector still in an uptrend here, but even it's been under pressure, but hasn't quite come down to its 200-day moving average at least yet. FANG index came right up to the 200-day moving average after Wednesday, and then we bounced back down from that. Apple was down 3.33%, a little bit more than that actually. See, these are the mega cap stocks, and they're just getting hammered right now. We were down 2.5% with Amazon below its 200-day moving average. Microsoft, which is in a downtrend, was down over 1%. Google under its 200-day moving average, down 2.6%. And Meta down 4.67%. Nvidia still below its 200-day moving average. It was virtually unchanged, but we're getting ready to see a death cross here with the trend. Tesla was down almost 3% after it tried to bounce in Wednesday's session. Netflix, it was down over 3%. And when you see these big moves like that, that's why the S&P is really getting hit right now. And still pretty much neutral, but seeing a bit of a pickup here when we compare US to world stocks in the short term. Still neutral, but showing that the relationship is actually getting weaker in the longer term. Oil was down, getting more into the mid 60s. The dollar still below its 200-day moving average, but it was up in Thursday's session. And we came down here with the 10-year yield. That means that we went up with the 10-year based on price. We're still just slightly below or just slightly in this red area with the 10 to the 3-month yield curve. So that means it's gone back to being inverted. And then we're still seeing overall weakness here with our growth to value ratios. Qs to S&P, discretionary to S&P, large cap growth to large cap value, large caps, mid caps, small caps, still showing weakness here. So what's our outlook for Friday? We're still negative in the short and intermediate term. We're below the 200-day simple moving average. That's long term. And we're losing that long-term support. Now, we could get it back on Friday. And that's a weekly chart. So if we close back above that, that would mean that support level is still holding. But of course, if we close below it, that means we're breaking that long-term support. We're going to get consumer sentiment, and that's pretty much it in Friday's session. And then whatever else comes flying into the news cycle that seems like pretty much everything right now is freaking the market out. And here's a look at the finishing of the economic calendar for the week. And this just goes back over. I actually went out and got the recent copy. What the forecast was, what actually came in, and then what the previous reading was here for the major economic reports that have come out this past week. Seasonality, we're actually quite positive for March 14th with the Dow, but we're neutral to negative with the S&P and NASDAQ. And you break this out a couple of different ways. We see some positive seasonality with the solid lines. That's everything. And we see nothing too negative here with the green dashed line. That's during a post-election year. And not living up to the first half of March being the second best performing period of the year. And still seeing some overall choppiness here as we start to enter into spring. So we're back to looking negative across the board with our smart money indicators. We haven't seen that in quite some time. And because we're below the moving average with accumulation distribution, but the other two continue to decline. The equity put call ratios are going up. That means there's more hedging going on. That's negative. The McClellan oscillators and summation indexes, both for the S&P and the NYSE, are negative. Parabolic SAR is negative. The bullish percent indexes are negative. On a momentum basis, the S&P is negative. The swirling trading oscillator is negative. We're getting extreme, but our moving average studies, they're all below 50, so they're all negative. Ease of movement, money flow, and ultimate oscillator are below 50 and negative. The vortex is negative, and the momentum for the NASDAQ 100 is negative. On the positive side, we're still hanging on to longer term uptrends with growth versus value and discretionary to staples. But we're seeing an awful lot of weakness right now, and it's pretty much turned negative. It has turned negative in the short term. The financial sector is still positive, but it's seeing weakness along with everything else. And the bank ETF is still under its 200-day simple moving average. So our conclusion, we're negative in the short term and intermediate term. We're mixed in the long term because we're below the 200-day simple moving average. And we're negative but oversold in the intermediate term and becoming even more oversold now well, we are oversold in the short term, becoming more oversold in the intermediate term. And we're mixed because we're below the 200-day simple moving average here, but we still have the longer term uptrend. Thank you. I hope you found this helpful. Have a really good day on Friday, and I will talk to you in the next video.